And Larry Hatheway is the chief economist at UBS Investment Bank. He's also the head of asset allocation and chief strategist. And he's warning the secular bear market in bonds has begun. Larry, let's start with that point. Clearly, you're not very optimistic about where the bond market is headed. Can you kind of talk us through what you think is going to happen? And that's very much related to the ongoing euro crisis.
Sure. Well, I think in terms of bonds, we've seen the low in yields in the U.S. The Treasury yield, the 10-year hit about 175 or thereabouts last autumn. I think from that point forward, we're in the midst of a gradual but inexorable rise in yields. And that's largely because the U.S. economy has turned the corner, is now embarking on a modest but nevertheless self-sustaining recovery. And that does mean over time gradual increases in interest rates and a sense that perhaps the Fed can't hold on to its current policy all the way to 2014. The Eurozone, which you also, of course, mentioned, could, of course, reverse matters if we see a further sharp deterioration in matters there, rise in sovereign risk premiums. But it strikes us that we're also perhaps past the worst points of the Eurozone crisis. It will flare up occasionally, but unlikely to necessarily have the same impacts that it's had to date.
That very much, I think, echoes what Angela Merkel was saying. She'd actually warned that we should expect yields or borrowing costs to rise for Germany because she also thinks the worst of the crisis is behind us. But Larry, how much of that depends on what happens in terms of the summits that they have today and possibly other ones? Because they're still talking about putting together bits of the structure of the euro. What do you need to see before you would more confidently say that the worst of the crisis is behind us?
Well, I think in the terms of the news over the next 48 hours, the Spanish situation is probably more important than the EU summit. The summit, of course, is going to focus on this sort of enhanced firewall, as they call it, with a joint sort of functioning for a period of time of the FSF and the newly introduced ESM. But I don't think the firewalls are what really matter to financial markets. What they want to see is progress on several fronts. Deficit reduction where required. We just heard about Spain. That's important. Structural reforms to promote growth. The Mario Monti plan, as it's debated in Parliament and moves forward, one assumes anyway. And of course, the issue of cleaning up banking issues where they remain. And again, that brings us back to Spain.
So it sounds like Spain is central. Now, its economy is expected to contract this year, as well as Italy's, despite the fact that they are making progress. I mean, do you think that that is going to just cause the crisis to possibly erupt later on if these countries struggle to meet their budget deficit targets? Or do you think that markets and economists can look beyond that and say that these are the right reforms for the medium term?
Well, I think some of them are the right reforms. I think you have to adjust the fiscal balance. You have to bring down those deficits. I'm encouraged by the willingness now of the Italian government to move forward with growth-enhancing, long-term growth-enhancing structural reforms. But there is a big agenda there. It is a painful one politically and socially, as we just saw again in the images from Spain. Having said that, what we have not really yet seen is anywhere a popular movement arise that says we need to do something radically different, right? Not even in Greece, an economy that has shrunk by almost a fifth today, do we see that emerging in the political constellation. The Greek Prime Minister is probably right that 80% or more of Greeks still want to remain in the Eurozone despite these very, very difficult adjustments. So we shouldn't underestimate the willingness to do what's going to be required, even if at times there will be setbacks.
The U.S. recovery is very much on the minds of investors. PIMCO's Mohamed Al-Arian warns, quote, "The economy is not yet in a position to handle the 4 to 5% of GDP, quote, fiscal cliff that is approaching as all of the hard political decisions that were postponed come into view at the end of this year." Larry, do you agree the economy is just not strong enough?
I would agree. I think it would be a policy error to implement the tightening that is on the books these days. However, I'd quickly add that the laws that Congress makes are the laws that Congress can unmake. I do think the tax cuts will probably expire at the end of this year because President Obama has declared that one of his priorities, at least for the top brackets. But I do believe that after the elections are over, whoever's in the White House and the new constellation that's on Capitol Hill, all those lawmakers will sit down and not so much for economic reasons, but for political reasons will say that amount of fiscal tightening, which remember is expiration of those tax cuts, of the payroll tax cut, and the sequestration, in other words, the automatic spending cuts that take place, all of those measures of tightening will be, I think, politically untenable for the Washington establishment, and therefore I think they'll sit down, reopen the 10-year budgeting process, the process that failed last November, and essentially push the fiscal tightening out into the future. So I agree with the quote, the economy is not strong enough to withstand it, but nor is the political establishment strong enough to withstand it, so they're likely to change the rules.
Kick the can.
Yes.
Yeah. In fact, I think Timothy Geithner just a few days ago said to the House they shouldn't play politics with the debt ceiling. I mean, do you think that's going to erupt again?
Well, here's one of the potential challenges. Suppose that we not just get divided government in Washington, but after November we continue to see polarized government, the two extremes that are there. In that event, of course, you will have to address the debt ceiling by the first quarter of next year at the latest, and you could see a rerun of what we saw last August. If, on the other hand, one side or the other feels it has a mandate and there's a workable sort of group there that can compromise and find progress, then we might avoid that particular outcome.
Do you think it has a ratings implication if that were to happen again?
I think it probably does, in the sense that either S&P itself or one of the other rating agencies could look at that polarized scenario and say there's just a lack of willingness to address the needs of the bondholder, and as a result of that, a ratings change is required. In the event, however, of course, the compromise is reached, that we reach an agreement on, say, 10-year entitlement reform and or tax reform, the rating agencies will probably take that in their stride.
I do wonder, I mean, Owen, we talk about this a lot in terms of how do you interpret the improving labor market? I mean, I think it'd be really good to get Larry's take on this, because we talk about 4-year low in terms of U.S. joblessness. I mean, is this something which you think is sustainable, or are you with those who say, well, hang on a sec, you know, in terms of being too optimistic yet about the unemployment picture?
For capital markets, for the markets themselves, this is one of the most critical issues. In other words, is the improvement of the labor market against what is still a relatively sluggish pace of growth of GDP sustainable? In other words, will rising labor income boost spending and therefore output? Or alternatively, is it a temporary one-off adjustment to get back to the level of employment that's consistent, let's say, with today's level of GDP, in which case then the labor market begins to slow? That, I think, is going to be the central thesis about the U.S. recovery that is examined and tested over the course of the next few months. My own sense is that rising labor income, more jobs, some increase in wages, some increase in the work week will in fact provide the fill-up in terms of household income to support stronger consumer spending, which in turn will generate the need for more jobs. In other words, a virtuous circle of income and expenditure. But that's a testable hypothesis, and we really have to see how it works out in the coming months.
Quickly, quantitative easing 3. Do you think that's coming from the Fed?
I think it's still unlikely. I think in the light of what I just said about the sustainable recovery story, and also in light of the fact that core inflation is sitting right around the 2% target of the Fed, that it's unlikely that the Fed will follow up Operation Twist with another round of QE.
Are you generally optimistic about a global recovery into 2012, 2013?
Well, I think matters are improving. I think to say you're optimistic would probably go a bit too far insofar as we're not really seeing the robust growth around the world, the improvement of income in Southern Europe and so forth. But I think that, for example, the Chinese economy is bottoming in the first quarter. We'll begin a gradual reacceleration through the rest of this year. No hard landing there. I think the U.S. recovery is now sustainable. And of course, Europe is still at pains, but Northern Europe remains one of the stronger areas in terms of growth.
Well, we spoke a few months ago. You were forecasting some growth, but rather weak global growth. Have you changed your forecast at all? What is your latest sort of set of numbers about what investors should be looking for?
Yeah, we still look at growth just at or below 3% this year, which is disappointing, but our most recent revision was actually slightly higher, and that was largely because of our upward revision to China, as well as a less bad recession forecasted now for the Eurozone. So at the margin, a bit higher.
Is one of the biggest threats, as far as you're concerned, both of you really, oil?
Certainly. We have to look at the soft patch last year. Obviously, there were Great Recession and previous downturns, and we can draw a clear link to oil prices in all of those instances. The level of oil prices is already high. The change, of course, isn't that big this year. But what we do know is that oil supply is very tight around the world, and it would only take the threat even of a disruption to lift prices significantly higher and to jeopardize the global recovery.
In fact, Larry, that's one of your 3 risks, isn't it? So you are worried about oil, you're also worried about a U.S. downturn, And you're also worried about what should happen to China. I'll talk a little bit about China because that is one of the things that lots of economists do worry about. Do you see more stimulus, more policies to boost consumption this year, or even a cut in interest rates?
You know, if you allow me, let's start first with the perception of Chinese risk. It's undoubtedly in the capital markets. The Chinese equity market continues to underperform. In the last 4 or 5 weeks, emerging markets have underperformed. Oil prices have again softened. Cyclical commodities, the Australian dollar, all of those are weak. They're all considered China plays. It's very clear that there's a consensus view out there that China is struggling to really find its footing in terms of growth. Now, from our perspective, we've been encouraged by the fact that exports, particularly to Europe, have not slumped as much as earlier feared. We're encouraged by policy towards easing. Banks are allowed to raise loan deposit ratios. We think the next set of numbers are actually going to surprise to the upside in terms of total credit formation. We're encouraged by falling inflation, which is halved from last summer's rate, which is boosting household income. Retail sales are quite robust. If people are looking for the housing market to lead the turn, they're looking in the wrong place. There are other parts of the Chinese economy that quietly are beginning to perform, and we think will underpin our view that the cycle is bottoming as we speak and that there will be an improvement later this year.
Would the government need to do what they did 4 years ago, which is to try and increase their own spending, because they are not going to expect a very robust amount of demand from the rest of the world, are they?
That's true. I mean, part of the recovery story is an easing of policy, fiscal policy towards things like social housing, other forms of infrastructure in Western China, and also credit easing, which I alluded to a moment ago. That plus what I said before about the household sector's income, real income story, are really the foundations of our view on China this year.
What about European growth, something we talk about a lot?
Or lack of it.
Or lack
yes.
of it. Are you expecting any growth from Southern Europe this year? But what about next year? I guess we're more interested in what you actually think when Europe will actually turn a corner.
Well, this year, unfortunately not. Most parts of Southern Europe will contract, Spain at about a 2% rate. We know that Greece is already contracting around a 7% rate. Portugal is in recession, and certainly Italy is on the verge of, if not in recession itself. But if we look beyond 2012, then I think there's some reasons to believe that Italy, for example, itself could begin to grow. Italy's doing less fiscal adjustment today and going forward than, say, Spain will have to endure, or other parts of the Eurozone. For example, France, which is a country that'll have to do a fairly big fiscal adjustment when the elections are out of the way. So I think Italy is probably one of those areas that will stabilize sooner. And then, of course, the other issue is Germany itself, which is continuing to grow. Unemployment continues to fall, and I think that's going to be the stabilizing factor for the Eurozone.
And I think that's on that positive note, perhaps that's a good time to end this countdown conversation. Larry Hatheway, UBS Investment Bank Chief Economist, we're both very grateful to you. Thank you very much indeed for your time today.